Let's start with a simple truth most people discover the hard way. Two stocks can move up 5% in a single day. One of those moves is meaningful. The other is a trap. On the surface, they look identical. Same percentage, same chart direction, same excitement. But underneath, only one has conviction behind it. That difference is volume. As you see on the opening slide, volume is often described as the fuel that drives market moves. And that's not just poetic language. It's literal. Without fuel, a rocket doesn't lift off. Without volume, price doesn't sustain. This entire video revolves around one core idea. Volume measures belief. And belief, collective belief, is what actually moves markets. Building on that idea, let's zoom out for a moment. Markets are not just numbers on a screen. They're crowds. They're millions of decisions made under uncertainty. Every trade is an agreement between two people with opposite views, and volume is the only metric that tells you how many people showed up to that argument. That brings us naturally to what we'll explore together, as laid out in the agenda. We're going to unpack what trading volume really measures, why liquidity quietly protects your capital, how volume confirms trends or exposes traps, and finally, how you can start using this immediately, even if you're not a technical analyst. Shifting focus now, notice how the introduction slide reframes the problem. Price tells you what happened. Volume tells you how strongly the market believes it. That distinction changes everything, because most beginners stare at price and ask, where is this going? Professionals look at volume and ask, who is participating? Let's ground this. Slide 4 explores the foundation, what trading volume actually is. At its simplest, volume is the total number of shares or contracts exchanged over a period. Every single trade has two sides, one buyer, one seller, no exceptions. That means volume isn't about direction, it's about participation. High volume means many people care. Low volume means most people don't. And here's the first subtle lesson. Markets move the most where attention concentrates. A price move on high volume is a public event. A price move on low volume is a private conversation. Ask yourself, which one would you trust with your money? This brings us to market safety. Slide 5 introduces volume as a liquidity shield. Liquidity sounds boring, but it's one of the most expensive lessons traders learn late. Liquidity determines how easily you can get in and, more importantly, how easily you can get out. High-volume markets have narrow bid-ask spreads. Orders fill quickly, prices behave. Low-volume markets punish urgency. They slip, they gap. They turn small mistakes into big losses. Think back to volatile moments in the market, earnings days, panic sell-offs, sudden news. In those moments, liquidity is oxygen. Without it, even good decisions suffocate. This is why professional traders obsess over volume before they obsess over setups, because survival comes before optimization. Next, we dive into something every investor cares about: trends. Slide 6 introduces a principle that's deceptively simple but incredibly powerful. A trend without volume is a promise without proof. Rising prices with rising volume mean more people are joining the move. That's belief expanding. Rising prices with falling volume mean fewer people are willing to participate at higher levels. That's belief shrinking. History is full of charts that look amazing, until you add volume. Think of hype-driven stocks that explode on social media but trade thinly. They rise fast and they fall faster. Not because the story changed, but because belief was shallow to begin with. This is where volume protects you from narratives. Stories sound convincing. Charts look seductive. Volume asks a quieter question. Who actually showed up? Shifting focus again, slide 7 takes us to reversals. This is where volume becomes almost psychological. Extreme volume often signals exhaustion. At tops, you'll see climactic buying. Everyone who wanted in is already in. At bottoms, panic selling. Everyone who could sell has sold. Markets don't reverse when no one cares. They reverse when emotion peaks. This idea shows up repeatedly in history. Asset bubbles don't end quietly. They end loudly, and volume is the noise. If you learn to recognize that noise, you stop mistaking emotional extremes for new beginnings. Notice how this mirrors human behavior. Overcommitment leads to burnout. Excess leads to correction. Markets are just people at scale. Slide 8 expands the lens. Volume depends on context. Stocks behave differently than ETFs. ETFs behave differently than Forex. Forex behaves differently depending on the session. Volume is not universal, it's relative. This is critical. Misreading volume across contexts is like using the wrong map in the right city. The data is correct, but the interpretation fails. So instead of asking, is volume high, better questions emerge. High relative to what? High relative to when? High relative to this asset's normal behavior. That question alone can elevate your decision making. Now we arrive at integration. Slide 9 shows volume paired with indicators. Here's the key insight. Volume is not the star of the show, it's the lie detector. RSI can show momentum, moving averages can show direction, and MACD can show acceleration. But volume tells you whether those signals are being confirmed by participation. This is where amateurs stack indicators and professionals stack confirmations. If indicators disagree, but volume agrees, volume wins. At this point, you've completed what the deck calls the insight architect level. Slide 10 marks that transition. You now see what most traders ignore. And awareness alone already changes how you look at charts, but insight without action fades quickly. Slide 11 brings us to practical takeaways. Track the 30-day average volume of assets you follow. Trade only moves confirmed by participation. Avoid low liquidity traps, no matter how exciting the story sounds. These aren't flashy rules, they're protective rules, and protection is underrated. Slide 12 introduces a weekly ritual. Review volume spikes. Journal what happened next. Note when volume confirmed your decision and when ignoring it cost you. This is how intuition is built, not by guessing, by feedback. Slide 13 asks you to reflect. Where did you ignore volume? Which losses were really liquidity mistakes? How could volume slow you down in a good way? Slowing down is not weakness, it's selectivity. Slide 14 zooms out again. Volume measures belief. Belief moves markets. Headlines don't. Opinions don't. Charts without participation don't. And this brings us to the conclusion. On the final slide, the message is simple. Trading volume turns randomness into structure. It helps you trade with clarity instead of emotion. It doesn't predict the future, but it reveals commitment in the present. Here's how you can start today. 1. Before your next trade, check volume first, not last. 2. Compare today's volume to the recent average. 3. If price is moving but volume is absent, wait. 4. If volume confirms, size responsibly. That's it. If you enjoyed this breakdown, subscribe, hit the thumbs up, and turn on notifications so you don't miss future lessons like this. And make sure to download the PDF in the description. It includes concise notes and exercises you can actually use, not just read. Remember, price is what you see. Volume is what the market believes. Learn to read belief, and you'll stop chasing noise.